Ladies and gentlemen, good day and welcome to Q1 FY'25 results conference call of Senco Gold Limited, hosted by Emkay Global Financial Services. We have with us today Mr. Suvankar Sen, Managing Director and Chief Executive Officer, and Mr. Sanjay Banka, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Vishal Panjwani from Emkay Global Financial Services. Thank you, and over to you, sir.
Hi, good morning, everyone. I would like to welcome the management and thank them for this opportunity. I shall now hand over the call to Mr. Suvankar Sen for his opening remarks. Over to you, sir.
Hello, good morning, everyone. As we begin the day today, I would like to wish each and every one of you a very happy Independence Day in advance, as we will be celebrating it tomorrow. And we have, announced our quarter one performance. We had our board meeting 2 days back, and would like to take this opportunity to talk about it with all of you today. If we look at quarter one, it's been a very exciting quarter, I must say. Especially as we have been discussing, last time as well, that it is a quarter of Akshaya Tritiya. We had our New Year's in many states, which as we begin the financial year, it is very important for us that we should start the year with a big bang and with a lot of excitement. So we had our launch of Bangle Festival and offers related to Akshaya Tritiya. And while this quarter was a quarter in which we had the elections that kind of state in part of the country.
Sorry to interrupt, sir. Can you please go again? Your voice was breaking in between.
From when did the voice go a little
after the Bengal season?
Okay. Thanks for letting me know. So after, Bangle Festival was on. We had our offers for Akshaya Tritiya. There were of New Year's happening at many states as we began the financial year. And while it was a quarter where we had our elections and the heat waves were impacting retail sales and footfalls at the stores in many places, we saw that during Akshaya Tritiya, our sales, those 41 days of sales that we had an increase of almost 20 to 21% in terms of sales value that it went up. And also, we must mention that this was a quarter in which the gold prices also were extremely volatile, and it had shown its upward trajectory moving upwards. So that also kind of impacted overall sentiments of the consumers. And therefore, in terms of the sales of volume that we got, the increase of sales in value terms was only 7.5%. And in terms of adding the new stores in that particular quarter, we added 6 stores, out of which 4 were company-owned, company-operated, and 2 were franchisees. So that was what it was. We have been planning and aiming to open about 18 to 20 stores for the whole financial year, and quarter one saw that we could open 6 stores out of the 18 to 20 stores, and out of that 1 store was in Dubai. So that was also a journey that we began to establish ourselves, our brand, with a global presence, reaching out to customers, not only from the Indian diaspora, but also Calcutta jewelry for its popularity and what it is famous for. The handcrafted product is appreciated by consumers of the Middle East, as well as there are consumers in Africa that appreciate Calcutta jewelry, and that is where we wanted to take it and use it as a beginning of a journey. and a platform to promote this handcrafted product to the other parts of the world. In terms of, if you look at the retail sales growth, we have seen a 9.6% retail sales growth. And the same store sales growth, if we look at it, it was about 4%. So in terms of top line, because of these multiple circumstances of elections and heat wave and the gold price movement, it was I would say a challenging quarter. But what went right was the fact that our ATV grew by almost 12% and our ASP grew by 13%. So in spite of the challenges that we have seen, our hedging also was much above 90%. So those kind of situations, we tried to mitigate the volatility. And even as the sales continued to happen, we built up stocks for the season. But post Akshaya Tritiya, the market became slower and slower. So we were focusing more on ensuring that we kept optimizing the stocks. I must mention here that while our endeavor always is to increase the diamond sales, and that would add to the margins, but this quarter one did not see that much growth in diamond sales. Rather, there was a degrowth in diamond sales by about 3 to 4%. So things were difficult, the sentiments of consumer, because when the prices rise, then the consumer, it has its impact on the gold component, the footfalls go down, and consumers want to procrastinate and postpone their buying purchases. In terms of the current situation, while the quarter one has now ended and we need to look forward and what we want to see ourselves as, the current recent situation of reduction of duty by almost 9% is a big boost to the industry. The way consumers were thinking that, oh, gold price is so high, it is not so good. And what we saw in quarter one was that it was the bigger ticket size items that were selling more. Those who had to buy or related to weddings, that they were more keen to buy rather than the smaller ticket sizes. But I think this duty cut would make the demand for consumers across wedding and non-wedding category to come and buy the product. And we are already looking at it in a very positive way. The footfalls have increased. In the last, I would say 15 days, the sales have gone up, and that is a very, very positive thing for the industry. In our quarter one, seeing the trend that yes, we were seeing more of the wedding customers, though wedding season wasn't much there. We launched the Gadbandhan collection, which was all about the wedding jewelry, necklaces, bangles. And I think that those kind of, focused initiative to cater to the targeted customers who are in a mood to buy helped us and enabled us to achieve the sales and attract the consumers. But currently we are seeing that it is all kinds of customers, be it wedding or non-wedding, coming to the stores and buying and products ranging from earrings in gold and diamonds, bangles, necklaces, all kinds of products are being sold. Yeah, what I have already, discussed and been saying that yes, the cut on the duty would have an impact on the, valuation of stock, because in spite of our hedging, how do we hedge? We hedge in two methods. One is hedging by selling on MCX on the sell side, or we take gold loan from the banks. Now, the gold loan from the banks that are being taken, that is duty paid gold. So yes, the international price movements get hedged by the gold loan, but the duty cut movements for the gold that you have already taken on loan from the banks, that portion of it is not hedged. So for us, that portion that is already bought through gold loan, we are analyzing, and we are assuming that approximately 50 odd crores of financial impact would be there due to the duty that has already been paid and the market value that being coming down. But at the same time, I think that the positive of increase in sales, more footfalls, the ability to ensure that we will be able to achieve the numbers, the top line growth of 18 to 20% will be in pipeline. And in terms of how do we manage this particular sudden impact, While on the other side, what position we had taken on MCX, out there we have been able to protect ourselves and mitigate this duty cut impact and have been able to get the right kind of result. But here, through increase in diamond jewelry sales or ensuring that the discounting aspect of it that we have, been seeing in the current market scenario, that players have been unnecessarily being aggressive in terms of their discounts and offers. And I think that mostly that would go with the fact that gold prices had moved so up. So they were all under the pressure of achieving their, targets and growing. And as a result, I think that the offers and discounts were a little more than what it was required to be given. But nonetheless, I think that we need to all modify ourselves and ensure that this duty cut impact is rationalized through rational discounting and offers to the customers and other cost-cutting measures wherever we feel that we can control our cost. We would be doing that to ensure that we get minimum impact, and this impact of 50 crores would be, I think, spread over the coming 2 to 3 quarters. You will not be able to see the impact directly in one quarter because the inventory is there, and over a period of time we will be adjusting it. So this is what we feel. The wedding season is much in place. We had our exhibition, as in the jewelry exhibition, India International Jewelry Show, that happens annually during the month of August. And we could, I would be happy to tell you that there were a large number of footfalls and, there were manufacturers, wholesalers, retailers, big and small. And I think that they were all very excited. There were a lot of business that happened. So I think this duty cut that has been initiated by the government is a good signal and a good support to the industry in terms of the growth prospects. And with the wedding season coming in, Diwali, preparing for.
Sorry to interrupt again, sir. Your voice got big.
What was the last thing that you saw?
Wedding season.
Wedding season, festive season, preparing for Diwali, Dhanteras, and all the stores are being now, they are reaching out to customers, and all the necessary steps towards a successful festive season is what we are focusing upon. Now I would request Mr. Banka to further elucidate and take you through the numbers.
Yeah. Good morning, sir. So you've given a quite detailed update on everything. So 2-3 points I want to highlight. One is that despite the challenges of growth and the industry competitiveness, while we grew at 9% overall, but retail growth was 11%. And once again, this is the highest ever sale in this quarter. Similarly, we have maintained a good control on the OPEX. The gross margin have also been in a good range, primarily because what we see is that subsequent to the earlier quarters, like last year quarter one or 22-23 quarter one, we've seen an improvement in the quality of our business. We have been constantly learning what is happening in the market and accordingly calibrating our marketing strategy, have kept a good control on our gold prices. So while in the market, we are recently talking about one India, one gold rate. At Senco, we are cognizant that a long-term sustainable business has to be based upon a value proposition, and the value proposition cannot come simply by giving the price cuts. So that we have maintained. Similarly, when the gold price rises, making charges are usually as a percentage of sales. So in a rising gold price scenario, while in terms of percentage or gross margin, it can look same, but in absolute term, we usually get a higher gross margin. So that is one. Similarly, in our pricing strategy for our franchisee, we have made minor corrections. So all these changes in our business model have improved and calibrated our inventory valuation, and all this has led to improvement in the gross margin, which we are seeing. As you already said, hedging percentage has been, we said in the press release also, has been 96%. So which clearly means that we are not concerned about the price movement of gold. And even though we knew that the gold prices will rise, still we maintained above 80% and risk up to 96%, which led a loss on the hedging position. Because as a company, we are committed to the risk management strategy. So while there were realization gains on the gold, which was procured in quarter 3 and quarter 4, that was mitigated or negated by the hedging loss, and still we managed a good margin, EBITDA margin and a PAT margin. So with that, we hand over the call, and the attendees, the respected investors can ask questions to us, and we'll be very much delighted to resolve to their queries.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. I remind you may press star and one to ask questions. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Shirish Pardesi from Centrum Broking. Please go ahead.
Hi, Shivankar, Bankaji, good morning. Thanks for the opportunity.
Good morning.
For good set of numbers. On slide 41, you mentioned that the revenue growth is 9% and SSG is 4%. Can you give some color how this SSG would have moved or revenue would have moved in April versus May and June?
So basically, in the first 41 days, the growth was 23% during the Akshaya Tritiya, and after and the prices were increasing. So it's not that the prices were not increasing in the first 41 days, but there was a momentum. The prices were despite increasing prices, we achieved a 23% growth rate. And suddenly, as the 41 days passed, sometime around 16th or 17th of May, by that time elections were also at the peak, and then the market had taken a dip.
Right.
So SSG during that period was certainly more than 10 to 12%, as you said, that when the growth is 20%, SSG is usually 60 to 70% of total growth. But overall, in the next period, the market collapsed, and that's what you are seeing, a 4% SSG.
Correct. So basically, I think the right way to look at it is that in the first 1.5 months of the quarter, it was a good season. The pickup was there, but post the middle of May, things started moving downwards, and that is where the average out SSG was what we are seeing of 4%, 5%. So if that could be, we don't have the exact month-wise data, so we are just giving, but then the April and middle till Akshaya Tritiya, it was more positive, and post Akshaya Tritiya, it was more challenging. That's what we can tell you.
Thank you, Shivankar. Just follow up on that. So if that growth is 20% or SSG growth is 10%, I'm sure the average sales price or ATV would have been higher of 80,000-90,000, because your average is about 74,000.
Yes, it would. In the beginning of the quarter, the ATV ASP was on the higher side. That's what we were analyzing, and there is no qualms about disclosing those facts. That we could see that it was most of the wedding jewelry type of products and heavier products that were growing. The necklace segment was growing, but smaller ticket size ring, earrings, pendants, and all of those categories were not growing to that extent. The business was happening. Rather, they were 10% on the downward trend. So we were wondering that what is happening? Why is it that? So then we realized that those consumers with the disposable income and those with the need to buy jewelry for weddings or for their special occasions were still coming and buying. But those ones which with their limited savings and funds who had to buy were thinking that, okay, might as well wait for some time and buy it later. So I think that's the trend we saw in the Q1.
Okay. My second question is that when I look at store openings, 6 stores, and if I look at the depreciation and amortization expense, which has gone up by 44%. So what explains? Is there any one-off we have done, or there is some refurbishment of older stores which has happened?
No, I don't think so. I will get back to you. Basically, there's no one-off expenditure.
Okay.
There's no one-off expenditure. There is some basically 12 crore to 18 crore. So during the last year, we have set up 24, 25 total stores and around 15, 16 owned stores. So this impact may be due to that factor that we added so many stores, and particularly one large size store that we said is Hathi Bagan, which was under CWIP for more than 4 or 5 years. So that was capitalized sometime in June 23. This may be an impact due to one of the Hathi Bagan stores, but there is no great impact that we can assure you.
Okay. Bankaji, last question. Your studded has now reached 10%, which was about 10-11%, which has remained steady. So could you spell out what is the target or what is the inputs we are doing to improve the studded ratio? And maybe in Q1, what is the wedding part of the business contribution?
In Q1, the studded ratio, sir, came down. Last year, on an average, the studded ratio was about 11.5%. Yeah. But in Q1, the studded ratio was around 9.6, 9.7%. So there was a lower traction and sales of diamond jewelry during the Q1.
So going forward, as you said, we have maintained that this Q1 was an anomaly, and not only for us, for the entire market. So we have been building the inventory despite we know that there are challenges in the diamond sale. So we have built up the inventory, we have built up the war chest, and if you look at our total inventory of around 2,400 crore in the balance sheet, to be precise, 2,593. So around 450 to 500 crore is a diamond. So we are clearly working out on the strategy. So we said that at least 100 basis points the stud ratio will increase. So while it has become 10%, 9.5 in the current quarter, our target remains the same. It is only 1 or 2 quarters, as you said, do not decide the journey. The journey very clearly remains a confident journey, and more so since our diamond prices are quite attractive vis-a-vis the competition. We are sure that we will achieve the 12.5 to 13% this year. But surely we'll touch 12%.
Okay. And on wedding, what is the contribution?
Sir, wedding contribution, the definition of how do we define a wedding jewelry is very subjective, but we assume that any product that is related to weddings, whether the price is above 1 lakh or it is specifically like say Mantika or certain types of bangles that is wedding related, we kind of try to take it. So it's usually around 40 to 45% is what we assume the wedding jewelry share is.
Thank you, Shivakar, and all the best to you.
Thank you. Thank you.
Thank you. We have our next question from the line of Ayush from Shravas Capital. Please go ahead.
Yeah, hi, am I audible?
Yes, you are.
Yes, sir. Good morning. I just had one simple question on the gold metal loan. So as far as my limited knowledge, I just wanted to understand how this is not being hedged, right? Because just to give you the gold metal loan is for 180 days, right? Just to give an example.
Yes,
and, usually if there's a rate cut, the prices adjust and then the banks are supposed to give back that portion of the loan because the loan to value ratio is not the same, right? Because that price has reduced, so the bank has to pay out, and if the price increases, you have to pay bank the extra kind of collateral. Right? So I'm just trying to understand.
Yeah, I will be happy to explain, Ayush. See, when you are taking the gold on a loan from the bank, the dollar rate, the rupee dollar conversion rate, and the international gold rate, those remains, open. So with the increase in price or the decrease in price, you can always fix it, and that is the hedging way to do it. But when you are importing gold into the country and you are taking the gold from the bank, then the duty that of 15% that you are supposed to pay to the government during the time of import, that is something that you have to pay upfront during the time of taking the gold, even in a loan. So you are hedged against the international price movement, you are hedged against the rupee dollar movement, but you are not hedged against the duty cut or duty increase. I hope I could explain it.
Yes, I did understand. Also,
so basically the 15% duty that was to be paid upfront for all the gold that we have taken on a loan for the last 6 months before the duty cut, that is where the impact is happening. That the duty, that 15% that you had paid is suddenly 6%. So that 9% difference between the duty paid and the current market rate, you are having to take a hit, and you will have to adjust that hit over a period of time.
Understood. Just one more question on mine. Could you just quantify what percentage is hedged via GML and what is hedged via MCX, just to give us an idea of the 90%?
Yeah, it is about, I think the 90% you could say 50-40.
Absolutely. This is almost 95% of our gold metal loan remains unfixed. So as sir rightly said, you can say, I would say 45 and 45, which 45 and let's say 50. So 96% we have said. So almost, I would repeat that, almost 90 to 95% of our gold metal loan remains unfixed. That is hedged.
No, he's asking that what
out
is
of the total
gold metal loan and what is MCX?
Sir, almost
out of the total hedging?
Almost 50-45 or 55-45. 55-40. Yeah.
All right. Thank you so much.
Get the answer?
Yeah, I'm done. Thank you so much.
Thank you. We have our next question from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Yes, hi. Good morning. Thank you for the opportunity. So first question was on the demand trend. That while qualitatively you mentioned that footfalls have increased over the last 15 days, can you elaborate on the demand or sales trend in the second quarter till date, and what kind of growth have you seen? Is it in line with the 20% guidance that you have given?
So I could give you some, what I can tell you is that if we were growing at what you saw in Q1, the growth of 9 to 10% in retail, correct? That growth number, as on date, can be assumed to be at 18 to 20%. So that is how you have to look at it.
Which means, Vidisha, that we are growing around 25 to 30% YTD. Sorry, in the second quarter. Till date, as of now. So that it has given us around 18 to 20% YTD growth.
Understood.
And that's what we have said, that we are confident that we'll overall achieve 18 to 20% growth throughout the year, subject to quarterly variances.
Got it. Yeah. Second is just a follow-up to the earlier participant's question on OPEX. There is a 25 to 27% QOQ increase in other expenses. So can you elaborate or clarify on this, and is this a run rate to be expected going forward as well?
No, this is not the run rate going to be. One is that last year first quarter versus this year first, more stores came into picture, right? So there is a volume variance in terms of new stores rental. So let's say total 15 new stores. So first quarter was only 3 because with the IPO money we raised the store. So one is a volume variance, and one is that since the market was down in the second part of quarter one, we spent a little more money on the marketing, but this is not the run rate. So you don't multiply it by 4. So, what projections we have said, that will be there. This is not the run rate.
Got it. Then, on the gross margin movement, if you could just elaborate on the 500 basis points expansion. And you also mentioned that there was some correction, there was some tweak in the franchisee model. So if you could elaborate on that as well.
No, I can't elaborate much on that. See, so these are the business strategy. So that we are looking at the EBITDA or gross margin improvement versus quarter one of last year or quarter one of 22-23. But the correct way will be to look at quarter three and quarter four. So our EBITDA margin in quarter three was around 11% and Q4 was 7.7%. And we said very clearly that this industry is clearly is subject to seasonal variations and clearly subject to price volatility. So whenever price volatility happens in one quarter or other quarter, it will show you EBITDA will get impacted temporarily. So long as a company is doing a 90% or 95 or 100% margin, the hedging, 90 to 100% hedging, they will remain fully protected, but from accounting perspective, the gross margin may look muted. And hence it is important to look at the gross margin and EBITDA over 2 to 3 quarters, which may not fall within the same financial year. I'm qualifying these sentences. Right.
So for FY'25, basically the gross margin would be in the normalized range of 15.5%, 15 to 16%.
Yeah. We have said 14.5. We have said 14 to 14.5 to 15%, and EBITDA we have said 7 to 8%. And this is subject to this custom duty impact. And we have said not only us, I think the entire industry, that custom duty impact has happened. So you can always you can understand 50 crore on the 230 to 40 crore of likely PAT. So we will take necessary actions to recover this custom duty impact by multiple actions are there which everybody will take.
Okay, got it. And lastly, given that the gold exchange component has been increasing QOQ since the last few quarters, what would you attribute this to? I mean, one part of it is that, of course, the elevated gold prices and consumer preference for organized retail has gone up.
What is the attribution?
Higher gold exchange clearly is for two reasons. One is the increasing gold price, and which is a major reason. The customer has to buy gold, he doesn't have money, and he brings the old gold. Secondly, the faith and trust and movement from unorganized to organized in the respective market. So in our market also, as we are market leader, this consistent increase, as you have said, that almost a major portion is a non-Senco gold. So clearly, the branding and faith and trust of Senco is improving, and we also want to take it to 40-45%.
And if you remember, just to add to this, that even in the last financial year or last few quarters, we saw an increase in old gold exchange, and we also shared some data on non-Senco gold coming into us and people exchanging, which showed that there is a preference of consumers towards the brands, not just us, but all brands, right? Because all the top jewelry brands right now are giving such offers to the consumer that even if they bring their other kind of old gold that has been bought by other jewelers, they would get the same kind of facility if it is above a certain purity. So I think that's what is attracting the consumers into the brands.
Got it. So where I was getting at is that at company and brand specific initiatives, we have increased our marketing thrust as well, which has also contributed to the increase in exchange mix. Would that be a fair conclusion?
Marketing expense.
No, marketing expense is not. See, marketing expenses cannot be linked to old gold. But you can say yes.
We are promoting.
Yes, so we are promoting. We are increasing marketing expenditure. Customer is coming toward the footfall, which is the objective of the marketing expenses. Then he brings his own old gold. For us, old gold is just a good currency. I will say old gold for us is a green currency. It's our commitment to ESG, and it is saving of the precious foreign exchange for India. So it's a good social service. We think that as a organization, citizen, we can do for our beloved country.
That's all from my side. I'll join back. Okay. Thank you.
Thank you. We have our next question from the line of Avi Mehta from Acquire Group Limited. Please go ahead.
Yeah. Hi, am I audible?
Yes, sir.
Yes.
Yeah, hi, Suvankar and Sanjay. First, I wanted to just, pick up on the last question about growth. Now, the 18 to 20% growth that we saw, is there more front-ended due to this front-ending of demand due to this custom duty cut that you see? And more importantly, just to understand the demand environment, you pointed towards some weakness in a segment which is concerned about incomes and maybe the entry level. Has that changed?
Yes, in the last 15-20 days, after the duty cut, we are seeing a change of the lower entry level ticket sizes. So that is one part of the question that you have given. And the front ending aspect of it is basically that, when there is a sudden reduction in price, and internationally, if you look at it, that the global uncertainties continue to remain, and the Fed rate cut and all of those aspects are factors that will lead to increasing of the international gold rates. So I think, from our perspective and jewelers' perspective, I think consumers are being made aware of those facts and the possibility of international prices going up. So they are being pushed or inspired and motivated to come and do their booking, buying for the coming seasons. So this is how it's happening right now.
Got it. And
Again, if I can add here, so what we said that in the second quarter the growth has happened. Higher growth is happening in the franchisee stores versus last year. So which clearly indicates that the tier 3 and tier 4 town demand is coming back, and agriculture sector, good monsoon, stabilization of the economy post elections, faith in the government policy, a pro farmer policy. I think most of them that's why the demand is coming back. And SSG also, one other participant asked earlier, I think Siri said asked. So as we had said earlier, that the SSG is usually 60 to 70% of total growth. SSG has also improved significantly, especially the franchisee one. So we are on course to 20% total growth, 13 to 14% SSG.
Got it.
As you can see today.
Okay, got it, Sanjay. So just a clarification, if I may, has the change in discounting levels also happened after this duty cut, or is that something that remains elevated? Because what the aspects that you alluded to about gold price rising further, does that worry you that this discounting is something that can sustain for a longer time?
No, so for the short term, I think that this duty cut has affected every jeweler. So everyone is conscious of the fact, and there will be plans and efforts towards rationalizing it. I wouldn't say it will completely stop, but things will get rationalized. So that will happen till the time that if the gold prices again shoot up very fast in a very short period of time high, then again for those short-term, attracting of footfalls and customers, it might happen. But if markets remain stable, then I think there will be rationalized discounting. So maybe, my answer is kind of a balanced answer, because very honestly, it's a very dynamic market, but based on situation, things will change. But if the situation remains stable, things will be rational.
Got it. And just the second bit, Suvankar, was on this lab-grown diamond foray. Now, how's the feedback been, and do you see, from a very broader perspective, do you see this, initiation or customer movement towards lab-grown in any way hurting the luxury and exclusive feel that typically has been associated with diamond jewelry?
So there are two ways to look at it. Yes, there was a aspirational and a luxury feel to diamond jewelry, and I think a lot of effort is being made by the industry towards building up that, continuing and building up it further with the formation of Natural Diamond Council, and promoting of natural diamonds. And it is rare. The fact is that it is rare and it takes so much effort to make it. But the lab grown aspect of it is also picking up, and especially it is in the bigger size diamonds that I think the market is getting impacted more, because now you can get it at a much lower price and you can fulfill your desire. So I think in the smaller size diamonds it won't be so much affected. So in terms of fashion and in terms of daily wear and casual wear, for the smaller size diamond, the natural diamonds will continue to play a role in terms of modernity and aspiration. But in the bigger size diamonds, while the people who will buy for their special occasions, of weddings, of their own weddings, of engagement with the natural diamonds, but for fashion, for the impulsive purchases or for the destination wedding, which is again another segment where people would want to wear exclusive designs, but for natural diamonds, those designs become expensive to carry. So those are the segments in which lab-grown diamonds, and with the wedding season in mind, I'm talking about it, will have a role to play. So this is how we have to look at it.
Okay, and how's the feedback been? I mean, how are consumers kind of looking at this? Any initial
So it is. I would tell you that what we saw, not just with our company, we are also building up the brand, doing pilot with 3-4 stores, trying to reach out to customers, because we have to play a very balanced approach, right? Because we are in the though we have created a sub brand and trying to create a different identity, but we have to protect the natural diamonds and ensure that people continue to aspire for it, as well as see the consumer behavior with the lab grown diamonds. But what I saw in the exhibition, that where we could see various companies, jewelers, big and small, everyone coming, there has been a lot of curiosity and increased curiosity and more acceptance. I think these are the words that should be noted, that is happening in the industry. Now the information percolation to the consumer will gradually happen. So the future is there, but it will not be able to completely take over the segment. It will have a small role to play in the fashion segment. I think that's how we have to look at it.
Got it, Suvankar. Thanks a lot. That's all from my side. Thank you very much.
Thank you. We have our next question from the line of Disha Podar from Caribbean Asset Managers. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah, Disha, you're audible.
Thank you so much for the chance. So I just wanted to understand that you have opened, one store in Dubai. So I wanted to understand the strategy of, opening further more stores abroad, and which regions would we be targeting, and would the economics be kind of similar, or how should we look at that?
No, Drisha, I'll tell you this is our, I would say the beginning and the first step towards, increasing the global presence, but we will have a very calibrated approach, and we will want to understand, the market and the sentiments, and, we would like to play our strategy, as I said, that, taking more product centric and karigari centric and design centric, and try to reach out to multiple consumers, not only the Indian diaspora. So there are no such big plans of many stores, but we will surely keep our opportunities open if there are, like the way we have been expanding through our franchisee model in India. We will always look for any kind of opportunities if they come in, but it is more important that we first build the brand and establish ourselves with our products and our services. So I think we will be in a very methodical and a calibrated manner doing our expansion abroad.
Understood. And secondly, sir, on the growth that you mentioned that, we'll be targeting about 18 to 20% growth for the full year. So how much of this can we expect to come in from SSG, and how much from the new 18 to 20 stores that we are opening?
That SSG will be around 10 to 14%. But 11, between 11, when we say 18 to 20, 11 to 13, 14 SSG. So the major contribution anyway comes from the SSG stores only.
Right. Okay. Thank you so much for this answer, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to take questions from all the participants in the conference, please restrict yourself to two questions per participant. Should you have a follow-up questions, we request you to rejoin the queue. The next question is from the line of Bhavya Gandhi from Dalal and Brocha Stock Broking. Please go ahead.
Yeah, thank you for the opportunity. So just wanted to understand, with respect to your lab-grown diamond jewelry store, what sales per store are we targeting? Have we even reached break-even? What sort of period do we need to reach the break-even levels?
No, it's a very good question, and let me tell you that we haven't reached break-even yet, right? It's been a 4-5 month journey. We are taking efforts to build the awareness. The targets, I might not be very comfortable to share the targets right now because of the circumstances. But let me tell you that the break-even is not reached yet, and it's the early stages of the journey. So yes, Mr. Bankar.
Yeah. No, I want to add one second that we have said very clearly that in the current year, in 24-25, when we talk about the stainless segment, which consists lab-grown, perfume, and the leather bags, the contribution is not likely to be more than 100 crores. I have said earlier 50 crores. I think between 50 to 100 crores. So it is not a very important part of our strategy for the current financial year. It's part of our vision to a lifestyle partner.
Right. No, I was just trying to understand because the stud ratio is on a higher side when it comes to lab-grown diamonds because your stud ratio is far better than your normal natural diamonds, right? So I just want to understand.
How are you saying it? I don't know. How would you be defining it? I don't know. Your calculation might not be correct to look at it that way.
Okay, so if you can help me understand, because lab-grown diamond, it's lesser caratage and daily wear jewelry, most of them that you are targeting. So I believe that the stud ratio is on a higher side, or is it not?
No, see, compared to a natural diamond, the stud ratio, is a combination of how we define stud ratio means we don't mean the stud ratio for the product. What we mean to say is that when we are selling, say, 100 jewelry, when we say it is 11.5%, that means that for us, 11.5% is the diamond jewelry or studded jewelry. That is how we define as stud ratio. And many of our industry players have achieved much better numbers in terms of 20% stud ratio or higher. So this is our definition of ratio. And I think what you say is that in any particular product, what is the ratio of gold vis-a-vis the stone component. So when the stone is a cubic zirconia or any kind of a semi-precious stone, then the value of the stone is lower compared to the gold value of the product. So there, obviously, that would mean more money that you can earn, lesser money that you can earn from the stone. But compared to a cubic zirconia or a semi-precious stone or American diamonds as they call it, obviously lab-grown is better. But compared to the natural diamond, the value of the lab-grown will be lower. So it is going to be a studded jewelry. There will be certain gross margins associated with it, but the ratio might not be that impactful in the overall stud ratio that we call it.
Okay, just let me ask in another way. I could have rephrased it in a better way. So, you are trying to say that 100 pieces if you were to sell, and 11% is the stud ratio, that 11% is the diamond jewelry sales, diamond jewelry pieces, I would say. That is how you calculate stud ratio?
Value. Let me make it more simple. Let's say we sell around 11 to 12 lakhs jewelry. So when we say 15% is will be 15% of pieces. So when we say my total sales is around 5,200 crore, 11 means around 550 to 600 crore is the diamond jewelry sale. Within around 55 to 60%. So when you look at the statute, you find maybe like 5 to 6%. When now we started at post listing, we started using the term stud ratio. That is 11%.
Okay, fair enough. And last question, if I can squeeze in. So what would be the pecking order for the studded elements? I mean, if you can just throw, I mean, obviously diamonds has to be number one, natural diamonds, but post that, what would be the elements of studs?
Okay. So diamond important element. The pecking order in the stud.
Your voice is not audible clearly.
Yeah, I'm saying that you mean to say in the studded element of it, the pecking order would be diamonds will be the topmost and highest share. Then there would be emeralds and rubies, right? Those will be there. And I must tell all of you, and you would be seeing it soon, that colored gemstones combined with diamonds, those have been in trend, and those will soon be the coming season designs we would see more and more. So in diamond there would be cut and polished diamond and polkis also, uncut diamonds. So that will be there along in the diamond part. Then rubies, emeralds. Then there are these other gemstones. Now lab grown is there. The lab grown can gradually come up and be in the second or the third position, but that will take some time. So this is how we have to look at it.
Got it, sir. Fair enough. Thank you so much. Really helpful. Yeah, thank you. That's it from me.
Thank you. We have our next question from the line of Vikrant Kashyap from Asian Market Securities. Please go ahead.
Good morning, Subhankar ji and Sanjay ji. Congratulations on very good set of numbers. First question is on your hedging policy. So you mentioned that 45 or maybe 55 is the hedge ratio between MCX and gold metal loan. But since we have gold exchange coming in and we have monthly schemes running, doesn't they provide natural hedging to you?
Yeah, so I will explain to you. See, one is that a hedging, when okay. So I'm saying when we are talking about hedging, we are talking about the inventory, not of the daily purchase sale.
Okay.
On daily basis, we get around, let's say, 25 to 30 kg of gold that it's hedged. But I have an inventory of 2,800 kg. So we have to hedge that inventory, because if the price falls and if the price remains fallen for forever or for 6 months, I have to sell my old inventory at a lesser price. You got me?
Mm-hmm.
So almost 50% of that inventory. So when we talk about 2,800 kg, around 1,400 kg is the whole metal loan with the banks. So the price is not fixed, and as if the price falls, yeah. So 50% is gold metal loan unfixed, and balance around 45 to 50% is the MCX future sale.
Mm-hmm. So I now I understand your point, Sanjay ji. My next question is no, it's very clear. The second part bit on in that, do we see gold metal loan increasing going forward for us and the mix will change?
So that is the intent. So we have said earlier that the gold metal loan percentage in our borrowing, we want to take it to 75%, so that my blended interest cost also falls. But it is a dynamics which we have to close with the bankers. Intent is very clearly to increase the GML as a percentage of total borrowing.
But we need to keep in mind that GML will not have an impact on if there is any further duty cut, then GML will not be the right way to hedge. So we have to balance it. So that is the thing we need to keep in mind.
Okay, great. Second question is on the demand side. Since we have strong penetration in tier 2 and below markets in the eastern region, have you seen any kind of reactions from unorganized players post this duty cut? Have they reacted differently, and what kind of impact you have seen on their businesses?
Till now, we haven't seen much of reaction from unorganized players. See, the way I think organized.
You're not audible.
Hello. I'm saying that the way the organized players taking, taking gold loan, doing exchange, the unorganized players are not doing so much of hedging. So they would be getting an impact on the financials for sure. But for now, because of the duty cut, the way we are also excited and elated that yes, consumers are coming and the transactions are happening and turnover is happening, I think they are also happy about it of the fact, and they are positive also and optimistic and thinking that no problem, again the gold prices will gradually go up, so it's a short term impact and in the long run it will all work out well. So I think that's the thought process that they are having, and there is no such great reaction from their side.
Okay, thank you, Suvankar. This is Subra.
Thank you. We have our next question from the line of Devansh Negotia from Safe Enterprises. Please go ahead.
Yeah. So thanks for the opportunity. Also, regarding the impact that you mentioned for 50 crores only for the duty cut, but I mean, if we look at our closing inventory, even for March, that is almost 2,400 crores, and a 9% cut on that translates to almost 180-200 crore impact. So why? I mean, can you help us understand the math behind 50 crores impact which you mentioned?
No, so you have to see that gold loan is what percentage of it, and the impact on the duty cut on the duty paid gold or that you take on gold loan. But the hedging that you are doing on the exchange, there you are not getting impacted. There you are getting a straight benefit. So it is only to that extent. And the 2,400 crore, just, because see, all of you will be doing your mathematics and doing your modeling. You have to understand that 2,400 crore mein, there are 400 to 500 crore of diamond inventory or other stones inventory, correct? So then you're taking the gold inventory only. And in that gold inventory, partially it is gold loan and partially it is MCX hedge. So then you do your mathematics and you come to a number. So I leave that mathematics and calculation to you, and then you come to your number.
So, but even diamond inventory has been correcting almost like 10% every quarter last one and a half years has been very weak.
See, the bigger size diamond is what has corrected more, which is like bigger size, above 50 cents. But, the smaller size diamonds, that correction is very limited, right? And if you look at our inventory or our sales, 80% is the smaller size diamond. So the impact of the diamond value has not been, I wouldn't say it would be much of an impact on the books.
Okay. Okay. And so just one last question on gross margins. I'm still confused because that the competition was very high, and even gold had corrected in this quarter. Not able to understand the reason behind gross margin expansion.
Gold has not corrected in this quarter. In Q1, gold has not corrected. Q2, gold has corrected. Right? So you need to ensure that, yes, the competition was high in Q1. And in that competitive intensity, there have been a lot of discounting and lot of, whatever price cutting that has happened, and that pressure on margins was there. But at the same time, you need to understand that optimization of stocks at what, how are you have sold more, but because of the gold price rise, you will not buy to the extent that you have sold. How do you manage your inventory? There are so many aspects to it. So the price correction is in Q2. So Q2 will be something that you will need to look forward on the impact of it. But Q1, was not so much on the price correction.
Q2 has impact of custom duty as well as fall in gold prices. Right?
Yes, Q2 has impact of custom duty and falling gold price, but it's more the custom duty that is impacting. All the gold price falling is also getting averaged out. So yes.
And so we mentioned.
Sorry to interrupt, sir. May I request you to please rejoin the queue, as there are several participants waiting. Thank you. Ladies and gentlemen, we have our last question from the line of Dhairya Trivedi from DJT Corporation and Investments. Please go ahead.
Hi, sir. Thanks for taking my question. So, sir, how do you see the net impact of this inventory loss of 50 to 60 crores because of custom duty reduction vis-a-vis the increase, that will happen on account of footfalls? So, do you think, the increased footfalls will kind of offset the inventory loss of 50, 60 crores?
Yes, we are very positive, and even if it is not going to offset to this extent, but through various methods of rationalizing discounting and other initiatives of increasing products with higher margins. These are certain broad strategies everyone will be taking, but I'm just calling it out. We will have to manage and reduce the impact. So I'm very optimistic that if not the full part, but a large part will be managed and adjusted.
Got it. And what will be the exit guidance, EBITDA guidance for FY'25 in terms of margins? Are we looking to maintain or increase margins from last year?
So see our guidance.
Sorry, sir, your voice is not audible.
I'm saying that our guidance on 18% growth on top line will continue. Our guidance on 18 to 20% growth on bottom line, ideally, post the duty impact, should be muted in the sense that there might be rather than a growth of 18 to 20, we should look at a growth of 15 to 18, if I may say so. But our endeavor will be towards making it higher than 18. But because of the impact, we need to understand that there will be some impact. So the growth on bottom line will be 15 to 18% growth. So I think that's how one has to look at it. But yes.
Kindly allow me to share my views. One is that custom duty impact has happened. So whatever Taras said, 40 to 50, we are getting into more details. But a 50 crore impact will happen within this year, and we are now working to take the necessary action. A clear picture will be able to give you after Q3. So right now, while the original plan was very clear, 18 to 20% top line and 18 to 20% bottom line, right now on the bottom line, it is better to remain cautious and comment on it after Q3. Significant sales increase. It's a question of 30 to 300 to 400 sales increase, which will counter this risk.
So the efforts will always be there. Efforts will be there, but it is what a fact is a fact, right? So we need to keep that in mind and have a conservative approach. And after Q3, both of us and you all will be more sure of what the scenario is. That is how I think one has to look at it.
Right, sir. Got it. Thank you so much.
Thank you. Ladies and gentlemen, that would be the last question for today, and I would now like to hand the conference over to the management for closing comments.
So thank you everyone for all the questions being part of the quarterly earning call. I must tell you that we really look forward to interacting with all of you, and every quarter for the jewelry industry brings in a lot of activity, a lot of excitement. There is the impact of economics, geopolitics, policies. There is creativity in it. There are new designs, collection, consumer behavior. So it's a wonderful industry to really be a part of, and I'm sure with all of you there, we are always there to hear you out, listen from you, learn from you, and hoping for a great Q2 and preparation for quarter 3 festive season. So thank you and happy Independence Day once again. Vande Mataram. Thank you.
Thank you. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.